Hi, I'm Jimmy. In this video, we're looking at whether or not the stock market looks like it's overvalued. Now, we did a video like this a couple of years ago, and at that time, this is the way the S&P 500 looked. We did a video right at the end of this data series, and if we're curious, at the time we had said that the S&P 500, despite the fact that it had pulled back some, looked like it was a bit undervalued. Well, fast forward in time, and we can see that it kind of played out fairly well. If anything, this is verification that doing the analysis as we're about to do it could prove to be useful for coming up with whether or not the stock market itself is undervalued or overvalued. Along the same lines as the PE ratio for the S&P 500, we could do the same thing for individual stocks. So let's imagine you were interested in analyzing a Canada pizza company. Well, looks pretty good on discounted cash flow. But when we jump over to the PE ratio, we can see that the PE ratio, compared to its own historical average, it actually looks pretty good. You can see what the fair value is on this table right here. So if you'd like to sign up to get access to this website, link in the description below. But for now, let's jump back to our analysis of the S&P 500 to see whether or not the stock market looks like it's under or overvalued. So let me tell you how we set this up. So this is the S&P 500. Blue line is the actual S&P 500. The green line in this case is what would the S&P 500 be if it traded at 15x? So 15 times earnings per share, PE multiple of 15x, that's what it would be. So the idea is for us to identify a good buying opportunity, a good PE multiple to stick with that gives us a reasonable number of buying opportunities, but not so many that we're overpaying for all different stocks. Well, we can see here that there was only one time period during this entire history if we thought 15x was the right spot to buy the S&P 500, there's only been one chance in the past 10 years. Clearly, 15x is a bit too low. Okay, now let's jump it up by 2.5x. Now we'll go to 17.5x. We get the purple line here. Well, here we can see that there's a few more opportunities. In fact, we've had 6 or so opportunities in the past decade to buy the S&P 500 below 17.5x for as far as an average PE multiple is concerned. That's not too bad. If we're a long-term investor and we're fairly strict, we have a real long investing horizon, perhaps 17.5x could be a good spot to try to jump in and buy it. And clearly, if we're going to use 17.5x, the market is way overvalued right now. Okay, that being said, let's jump over to the PE multiple that I think is far more appropriate from an S&P 500 standpoint, and that is 20x, the light blue line here. Now, let's clean this up a little bit just to try to make it a bit more readable. But 20x is actually what we used in our last analysis like this to try to see whether or not the stock market was under or overvalued. We did it right around this time period. And right there, well, this was right after the stock market had pulled back a decent amount. I know for me on a personal basis, I bought quite a few different stocks when the market was pulling back, because when we zoom in a little bit, well, we can see that the market had pulled back, but it looked undervalued because the blue line was below the light blue line. Two blue lines. What are you going to do? You know, the blue line was below the light blue line, was below the average. So the stock market looked undervalued, and we were buying companies that looked undervalued. So it was kind of a win-win. Okay, now when we jump in and look at the entire decade, well, we can see that there have been plenty of opportunities to jump in using 20x as a multiple. There's been plenty of opportunities if we're just mildly patient as long-term investors, long-term buy and hold investors. 20x has been a fairly reliable level for the S&P 500. Okay, now jumping back to our bands, now we can go up one more level. This time we're going to 22.5x, so 22.5 times earnings per share. Well, here we can see that, first, let's clean this up a little bit, and then we can see that there have been a crazy number of good opportunities to buy if we believe that 22.5x is the right valuation method, or the right valuation level, let's call it. My issue with this is that the reason I prefer 20x over 22.5x is that there's so many opportunities that you're not really eliminating. You're not really waiting. You're only, frankly, avoiding the super extreme levels, which, by the way, right now, looks like it's a super extreme level. Okay, now going back to our bands, well, now we're going to our final level up one more, up to 25x. And again, we clean this up. But this time, we probably don't even have to clean it up because it's probably faster to point out the times that you wouldn't have bought this stock. Mostly being back in 2021, back when the government was dumping tons of money into the system, giving out money to individuals, the stock market was overvalued then. The only exception is right now, where the stock market is in fact overvalued, because right now the PE ratio for the S&P 500 is about 26x. So clearly, it's overvalued. So depending on what company or what industry you're analyzing, well, you can determine what PE multiple you think is most appropriate for the broader S&P 500. For me, on a personal basis, I got to stick with 20x. If we look back at history, 20x is proven time and time again to be a reliable level to determine whether or not the stock market as a whole is undervalued or overvalued. And right now we can see it looks way overvalued. Now, I do want to point out that the S&P 500 is a forward-looking investment, so it going up, jumping up as interest rates are expected to decline, is not terribly surprising. But for me, on a personal basis, this is one of the reasons why I'm sticking with individual companies. It's one of the reasons that we have the investing platform that I talk about a lot at the start of the videos, because I truly believe that we have a chance to beat the market. If we buy the market when it's undervalued, you buy an ETF like a VOO or an SPY, but then you can buy individual companies that they themselves, maybe their industry is undervalued. I think buying individual companies, if you do the research and you've put in the time, can be hugely valuable to investors and can ultimately lead to us beating the long-term average of the S&P 500. So if you want to sign up to get access to the website, to the Investors Grow website, I will leave a link in the description below. And if you're curious how to research individual stocks so you can do a deep dive and be confident with your analysis, I actually did a video called 8 Steps to Analyze a Stock. You got a link right here, link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.